you will find out that. Plus, it is also evidence from a physical count at the end of the year, which is normally we do some audit. Audit is a separate subject, so I'm not going into that. So because it is also like cash or inventory, because these two items, they are more vulnerable or susceptible to fraud, right? So that's why at the end of the year, every business or public company, they have they have requirement to go for audit to have a physical count whether the inventory is not stolen or it's in a perfect condition. Okay, consigned goods. So does not include those held for another company. Does includes those out of consignment. What does it mean? So when you sold the goods, right? So when you receive the amount, let me just give you the example. So this is Mr. A, and this is your company, and I call this company XYZ. As soon as Mr. A transferred the amount, the goods belongs to Mr. A, means sale occurred. So that goods that are still on your godown or on your stock, so that portion of the goods that belongs to Mr. A, that does not include in inventory on balance sheet, right? Because that belongs to Mr. A. Maybe you will send to Mr. A after 3 days or after 4 days, after a week, whatsoever. So that's why it does not include. And when it is include, when they are on consignment. For example, you are, you receive the goods you receive the dollar in advance, and you will tell that, okay, we will going to send you the goods later, right? So in that case, the ownership is not transferred, ownership is still with the company. So you can say that, okay, so these goods belong to company, right? In transit goods depends on shipping terms. So let's talk about these shipping terms, whether they belong to inventory or not, up to what level they belong to inventory. So shipping terms, we have free on board shipping point and free on board destination point. So you tell me, if customer said that you send the goods to my house, so sale is occurred or ownership is transferred to the customer when he received the goods, because he said that I would be paying you for the sales to deliver the goods on my destination. So when the goods are received on destination, then sale occurred, and then you can say that, okay, sale occurred, now we can decrease our inventory and increase our cost of goods sold. Inventory is a balance sheet item. Costs of goods sold is income statement item. So destination point, when destination arrived, then inventory decreases, cost of goods sold increases. But for the FOB shipping point, so if the customer agree that, okay, ship the goods to a certain port, for example, Shanghai port. If a Chinese person want to import goods from another country or another city, and the terms and conditions are like that, you send the goods on shipping port. That's it. So rest of the transport charges or whatsoever, it will be borne by the customer. So as soon as the goods arrived on the port or shipping destination, sale occurred. Now you can decrease the inventory from balance sheet and increase the cost of goods sold for income statement, right? So company with legal title to goods while in transit pays the transportation cost. So in this case, in destination, transportation is borne by the company. FOB, shipping point, only up to the point of port, borne by company. Not on customer's destination. If the customer says, say that you need to, deliver the goods on my factory, then till the goods arrived on the factory, the freight charges, the transportation cost, all belongs to seller. If the customer said you need to send to my, to my factory, but FOB shipping point is there, it means only the company is responsible up to the shipping point. So all the cost, insurance cost, freight cost, transportation cost up to the shipping point, and rest of the cost is going to be borne by customer. So from shipping point to the factory, that cost is borne by customer. Understand? All. So those who are working with the import and export, they do have this kind of knowledge. Okay, let me erase all this stuff. So here, so ownership changes hands at the point where goods leave from seller's shipping dock, at the point of delivery of the customers, right? Now let's talk about the accounting for inventory in the perpetual system. So there are two methods of accounting for the inventory. Number one is perpetual inventory system. Number two is periodic inventory system. So let's talk about the perpetual. So perpetual can be used for all type of goods. It keeps a running record of all goods bought, sold, and on hand. So inventory counted at least once a year. Whereas the periodic system, these are used for inexpensive goods. So it do not keep a running record of all goods. Inventory counted at least once a year. Right? So what is the difference here? The difference here is that in perpetual system, we keep a running record. In periodic system, we don't keep a running record. That's it. Right? So for example, if inexpensive item, for example, a company who is making papers, they cannot track all the papers. Okay, 1 kg papers is sold today and they make an entry. 2 kg paper is sold, they make an entry. So they just record once a week. They say that, okay, this week we sold 100 kg papers and 100 kg papers, let's record this, that's it. Or factory who make yarn, or the clothing industry who make buttons, these kind of stuff. The perpetual system is very good for like expensive parts. Okay, 1 Bugatti is sold today, you make an entry. 2 Bugattis is going to be sold after 2 days, you make an entry. In 1 week you sold 3 Bugattis, but for these 3 Bugattis you have separate entries, right? So that is the difference here. So how the perpetual system works? So normally this is the age of electronic commerce. So everything is controlled by electronic stuff, e-commerce stuff. So we have barcode scanners. You scan, it records the sales. So it updates the inventory. So whenever when you scan the barcode, same like you go for text. You go to Tesco or Carrefour or any other supermarket store. So they scan it. When they scan it, and they enter to confirm the sale. What happened? The inventory goes down. Cost of goods sold increases automatically. So 2 entries needed for each sales. Number 1, you record the revenues and asset received. So when you sold, entry would be cash to sales, right? The revenue is going to be recorded and asset is received. Cash is our asset. The other thing is that we record the cost of goods sold and reduction in inventory. So entry would be cost of goods sold to inventory. Inventory decreases, which is credit. Cost of goods sold increase, which is expense. Expense increase, debit. We'll talk about these entry in our coming slides as well. So any question up till now? Aroni, Chloe, Junpyo, Min.
So far, it's okay.
Okay. Okay, good, good, good. Okay, so let's move forward. So now recording transactions in perpetual system. So if we have a credit sales, okay, number one, I think when you purchase inventory, what is the entry? You purchase on credit. Inventory increase, accounts payable, which is our supplier increase. So inventory to accounts payable. Inventory increase debit, accounts payable is our liability increase credit. So we purchase an inventory on account. And now what happened? We sold the inventory on account. What is the entry? Sales increase credit, right?